Very, very special voice right here on the Big Reset. I'm talking about none other than Professor Bibek Debroy, member of the Niti Aayog, and somebody who's got the Prime Minister's ears when it comes to economic issues. Professor Debroy, we really appreciate you joining us on ET now on the Big Reset. I know you were a part of that meeting and you categorically don't want to talk specifically about it, but just to take forward from the state of the economy that was discussed at large, in an interview to ET now, both the CA and the Finance Minister seem to suggest that there is an opportunity that a slowdown in China seems to be bringing to India. Yes, given the kind of and the size of our economies, we will not perhaps be the global engine of growth in accordance to how China was, but we can shoulder some part of it. What are your views on the fact, can India really be that engine of growth, take some burden off China?
Because of what is happening in China is something that is still in the process of unraveling. I don't think we have seen the end of it. In the foreseeable future, both the forex market and the capital market will witness volatility. So I think volatility is something that we have to learn to live with. The second point I want to make is that what is happening is not only about China, because there are other economies in the world which are much more integrated with the Chinese story, manufacturing or otherwise, and those countries are also going to suffer the consequences of the slowdown in China. And the reason I'm flagging this is because it's fairly clear, obvious, that China cannot sustain the kind of growth rates it has sustained in the past. So therefore, China is in for a slowdown. That is also something we have to live with. The third question is the one you really asked, which is that is it an opportunity? Yes, it is an opportunity. It's an opportunity because global prices of natural resources are going to be low. It's an opportunity because China is vacating some of the manufacturing areas it has historically occupied, including labor-intensive ones. But to tap that opportunity, A, we need to invest in infrastructure and skills, and B, we need to introduce all kinds of reforms domestically.
That's a valid point that you're making, that to get anywhere close to China, we will have to make investments here in India. So the question that I'm asking is that there's been about 15 odd months since this government has come into office. It was a very positive sentiment to begin with. The narrative was very positive, and yet investment hasn't broken ground. What do you attribute this peculiar situation really to?
Well, again, there are different kinds of responses I can give to that. Some of it is what I would call legacy. Meaning there are problems connected with the land legislation, there are problems connected with forest and environmental regulations, there are problems even connected with labor legislation, and many of these things are a legacy of the past. And one must remember that changing any legislation is a time-consuming process, if at all it can be changed, because it has to go through a parliamentary process. The second point I want to make is much of this is actually a state government subject, and states do react differently. And after all, what we have had is a government as an union government. But the other response I would have is sometimes when we are reacting to data, we are reacting to data with a time lag. And what I think is happening now is that public investments, or certainly certain kinds of public investments, are beginning to happen. And therefore, private investments will begin to respond with a time lag of perhaps 2 quarters, 3 quarters. And therefore, I'm fairly optimistic that the point that you're making, and it's a valid point about investments, that is going to reverse itself 2 quarters or 3 quarters down the line.
All right, that's a glimmer of hope here, and that's also perhaps the big headline that 2 to 3 quarters from now, we will see perhaps the impact of the investments that the public investment vehicle is beginning to make. Sir, before I go on to the investments per se, I have a question to ask of you. You spoke about the reform process. When this government came into office, and because of the numbers it has, there was obviously irrational exuberance. Then, of course, the expectation was reset in some form. Today, do you believe, in hindsight, the legislative logjam that we are seeing on things like the land bill, on things like the GST, is this reality that we will live with, and is this the price that democracy and growth will have to pay for?
No, I wouldn't quite put it like that. Because if there is a trade-off between democracy and growth, which I don't buy, but if there is one, I would say there is a premium attached to democracy, and most of the time we don't attach that premium because we take democracy for granted. Having said that, let's talk about the specifics of these two. The GST. Essentially, Parliament has not been functioning. If Parliament functions, then one can have a debate as to what should happen to the GST bill, what should have happened to the land bill. But on the GST, let me ask the following counter question. Is the objective to get a GST bill passed in a hurry, or is the objective to get a good GST? The reason I am flagging this is, take this demand that the maximum GST rate should be 18%. How do you know in advance that the maximum GST rate should be 18%? How can you even commit to that? Because the revenue neutral GST rate is a function of what exemptions are going to be removed. And until we know what exemptions are going to be removed, we don't know what the revenue neutral GST rate is. And who has the responsibility for determining that GST rate? The GST Council has. So how can we preempt the powers of that GST Council? Similarly on land, let me only mention in passing that I think constitutionally, not in terms of the law, but in terms of the spirit of the Constitution and in terms of the spirit of the 7th schedule, the 2013 law should never have been enacted because land is not on the concurrent list. Land is on the state list.
All right, so the 2013 law would not have been enacted because land is in the concurrent list and not, it's a concurrent matter. But sir, I want to take this matter away and talk about unclogging of projects. We've seen big projects being stranded and you know, it has an unraveling effect because it impacts a bank's balance sheet, it impacts the NPAs. So it's a vicious cycle, so to say. What are some of these steps that the government is taking at this moment and steps that have been told to India Inc. To unclog these projects? Because that is where the problem really begins.
Yes, I do think there is a problem. You're absolutely right, because we are talking about two different things. One is to get new investments going, and the second is to unclog some of the existing projects that have been stuck. To the best of my understanding, some of these projects have actually been unclogged, but there is still a large number which are stuck in the pipeline. And I think what one needs to do, and the Finance Ministry has been talking about it, is some form of capital infusion into some, if not all, public sector banks so that they can actually reschedule the projects. But let me flag a different kind of concern that I think we should be debating about. Once upon a time, we used to have the DFIs, the Development Finance Institutions, and in the flush of reforms we thought that the DFIs were no different from banks, and why should we therefore at all think in terms of these silos, and the two, the DFIs and the banks, should blur into each other. But the fact of the matter is that banks, the commercial banks, are singularly ill-equipped to handle funding for long-term infrastructure projects. So therefore, as a country, we need to figure out a means for getting funding for many of these infrastructure projects which will take 20 years to yield returns. And remember, most of infrastructure is still funded via the debt route and not via the equity route.
One of the things that is perhaps working to our favor, sir, and I'm shifting focus really to the global cues now. I mean, one of the things really is the softening in the commodity basket, especially crude oil price crash. It gives us a huge elbow room as far as the fiscal arithmetic is concerned. What kind of an impact does this really have on the budget mathematics? Is this a windfall of sorts as far as the finance ministry or the government's own exchequer is concerned?
Yes, I mean, that is a very simple answer, that whether it is in terms of the current account deficit, which actually is not going to be a deficit in all probability, or whether it is in terms of the fiscal deficit, it makes life much easier. But one of the questions to ask is, we are sitting on a fairly large kitty of foreign exchange reserves. Is there some better use that can be made of these foreign exchange reserves? Because the foreign exchange reserves yield very low rates of return, because they have to be, within quotes, invested in a certain category of assets. To put it a bit differently, can a certain percentage of these foreign exchange reserves be used to drive infrastructure investments? And infrastructure investments also incidentally become easier because of the factor that you mentioned, which is lower prices of many commodities.
That's a fair point, Indy, but is there thinking within the government to use a percentage of the forex reserves to fund infrastructure projects? Has the thinking within the government begun on this matter?
No. If you are going to ask a question about what is the government thinking on that, that would have to be answered either by Finance Ministry or by the Reserve Bank.
While you're talking about the Reserve Bank, I especially want to speak to you about the turmoil that has been seen in the Indian rupee. I mean, the way there has been a weakness, and of course this is due to global factors, how the dollar has strengthened against our own currency. We've been hearing the governor and the voices from within the government essentially saying that we've got enough forex reserves to put to use if the need be. What is the time limit that you're going to give to the rupee? Should it hit 70 before those forex reserves are put to use? Is this relentless weakness perhaps a natural factor, and you believe intervention should not be made at a policy level?
You see, look, volatility is going to be a part of life, as I said. We are going to have this volatility. Conceptually, you can say that I should intervene in markets, foreign exchange markets, in either direction to cushion the volatility but not arrest the secular trend. Conceptually, it's fine to say that. The trouble, of course, is in practice it becomes very difficult to distinguish and separate out the volatility from what is a secular trend. And whichever way one is intervening, that intervention is not without its costs. There is always a temptation to encourage depreciation because depreciation is required for exports of goods and services to remain competitive. But depreciation also has a cost in terms of the enhanced cost of imports. So I can understand the reason for intervention, but all I'm saying is one has to be a little bit careful because there are costs and because one should stem the volatility, not the secular trend. You also asked me a question about the value of the rupee vis-a-vis the dollar. Now, had I been able to predict that I would have been gone out into the forex market and made some money. So that is very difficult to predict. But I would say that I see no particular reason for the rupee to touch 70 rupees. I don't really expect it to slip by more than a rupee or so over the next 6 months.
Professor Deb Roy, every member of Indian industry that you speak to today essentially turns around and says that the rate of interest is very high in India for us to begin investments. I have a very frank question to ask of you because that is an easier explanation that they give. They're also sitting on stretched balance sheets, over capacities. Those are the other reasons. But just from your point of view, and I urge you to wear your economist hat while being in the government, the governor has said that we are in an accommodative phase and there is perhaps room for a rate cut. How much room do we have for a rate cut? The demand from the industry is 75 to 100 basis points. I'm not going to discuss whether there should be a rate cut or there shouldn't be a rate cut because we're already talking about risks of deflation. How much elbow room do we have to cut rates? A 75 or 100 basis points rate cut, do you believe is irrational to be spoken about?
Let me answer a question that you haven't really asked. I have a feeling that the rate cut issue is not as important as is being made out to be. It becomes an important issue, obviously, when there is demand for investments, but as you rightly said earlier, that there is no great demand for investments, and as you said, right now there is excess capacity which is linked to investments not really happening. Having said that, it is somewhat difficult to determine what the real rate of interest in India is, because it becomes a function of whether you're going to use the WPI, whether you're going to use the CPI, or whether you're going to use the GDP deflator. Having said all that, let me directly answer your question and say I find it very difficult to see how the central bank can reduce interest rates by more than about 50 basis points. So 0.5% is what I think is going to be the maximum, which may be important as a signal. It may be important for certain sectors, perhaps like automobiles and housing and real estate, but across the board, it is no more than addressing the issue of sentiments.
it's a valid point that you're making, but I can turn around and ask you that because voices in government are already voicing concerns on the balance of risk now shifting to deflation, shouldn't the rate cut be more aggressive?
To make a significant impact, if it is a purely interest rate issue, as I just argued, I don't think it's a purely interest rate issue. But if it were to be a purely interest rate issue, to make an impact, one would need interest rates to be slashed by at least 2%, if not more. Do I see the central bank, and remember all central banks throughout the world tend to be conservative. Do I really see the central bank slashing interest rates by 2%? No, I don't think so.
I have a last question to ask of you, Professor Debroy, before I let you go, and that question is really coming in from the other elephant in the room, and that's the U.S. Federal Reserve and what it does with interest rates. The September rate hike is perhaps being ruled out because of the U.S. own unemployment data. But eventually, whenever that hike happens, do you believe it's been budgeted for? Are we going to see pain, irrational sentiment take control of how equity markets around the world participate, and India is not going to be an exception in that?
In the short run, yes, because in the short run it's not just India which has been suffering, but all the emerging markets have. And in the short run there is of course going to be the volatility. In the slightly medium term, the simple response is very simple, that in how many countries in the world can you possibly get the kind of returns that you're going to get in India? Therefore, after the volatility in the short term, I'm fairly confident that capital inflows, both of the portfolio kind and certainly of the investment kind, the proper investment kind, will return.
All right, Professor Debroy, it's always a pleasure chatting with you and to get your views on everything that's related to Indian economy, an important stakeholder, speaking here with ET Now on the Big Reset. Thanks very much, Professor Debroy, for sparing time and being with us this evening. Thanks very much, viewers, for being with us on this very special edition of the Big Reset, when the Prime Minister decided to do some tough talk and also listen in to some of the suggestions that came in from India Inc.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.